We're here to, cut through the noise and help you get genuinely informed. And lately, it feels like stablecoins are just popping up everywhere, doesn't it? I mean, one minute you see these major headlines about new laws like Donald Trump's Genius Act or Hong Kong putting its stablecoin ordinance into action this August. And then, boom, the next day you're reading these really quite unsettling stories about digital currency fraud, scams.
Right.
It's a lot.
It really is. And that contrast, that sort of whiplash between official moves and, well, fraud, it just highlights why understanding this space is so urgent now. It goes way beyond just the headlines.
Yeah, it's this weird mix, right? Legitimacy on one side, confusion, even chaos on the other. And, the basic idea, digital currency anchored to real assets, sounds simple enough at first.
Deceptively simple, maybe.
Exactly. Because you pull on that thread just a little, and suddenly you're tangled up in, blockchain, Web 3.0, this whole idea of a decentralized internet, and then U.S. debt, dollar hegemony. It feels like this huge, complex web.
You can definitely feel overwhelming.
But that's why we're doing this deep dive. Our mission today is really clear. We want to help you unpack the big picture logic. What are stablecoins really? Why now? Why did they pop up at this moment? And what's their actual potential, looking forward? Think of this as your way to connect those dots, to make sense of all those scattered headlines in one clear story.
And that story element is key. Like I said, the contrast between legitimacy and fraud makes understanding urgent. We're not talking about some niche finance thing here. This has truly global implications. And sometimes, to really get the cutting edge, you need to look back. You need to understand the historical bedrock that's being shaken up.
Okay, let's do that. Let's go back. Picture this. A time not actually that long ago when the U.S. had this huge strategic goal. They wanted the dollar to be the currency for global trade, period.
The world's reserve currency.
Right. So imagine, say, Japan wants to buy oil from Saudi Arabia. They couldn't just pay in yen or rials. No, Japan had to first swap yen for U.S. dollars, pay Saudi Arabian dollars, and then Saudi Arabia would swap those dollars back into rials. Everyone went through the dollar.
Seems cumbersome now, doesn't it?
It does. But the advantages for the U.S. were just massive. Unbelievable, really. First, total financial security. The whole world needed its currency, so the U.S. could always buy whatever it needed internationally. No worries there. Second, and this is the real kicker, it gave them incredible leverage. Other countries held huge amounts of dollars, often in U.S. banks.
There's stability for trade.
Exactly. But if things got tense politically, the U.S. could just freeze those accounts, cut off access. The power that gave them was almost beyond reason, and this whole system, this dominance, that's what we call U.S. dollar hegemony.
And it's crucial to grasp why other countries played along, even knowing these risks. It wasn't just about being forced into it. The dollar was seen as stable, reliable. It had unparalleled purchasing power. It was, the bedrock.
So trust was a big part of it.
A huge part. And to cement that, there was a really pivotal deal in the 1970s with Saudi Arabia. Basically, the U.S. offered military security. In exchange, Saudi Arabia agreed to price and sell its oil only in U.S. dollars.
The petrodollar agreement.
Precisely. That was a masterstroke. Suddenly, oil, this thing every single country needed, required U.S. dollars. Naturally, other oil exporters followed suit.
Yeah.
It effectively anchored the dollar to oil, this universal commodity. That created this incredibly powerful economic moat, locking in global reliance on the dollar for decades.
Decades of dominance. But, like you said, even the strongest systems face change. And that dollar hegemony, that seemingly solid structure, it's definitely showing some cracks now.
The landscape is shifting.
It feels like a slow shift, like just the tip of the iceberg showing. Now, that direct link between the dollar and oil, it's loosened up quite a bit over the years. That's a big deal. But let's be clear. Dollar hegemony isn't just going to disappear tomorrow. Countries still hold vast reserves. What was it, 57.7% of global reserves in Q1 2025 were still dollar assets.
Yeah, though that is down significantly from 71% back in 1999. So the trend is clear.
Right. And plus, the U.S. financial system is so deeply embedded, so mature, many nations still depend on it. But the trust in the dollar itself seems to be eroding. That feels like the core issue.
Definitely.
You look at the U.S., $37 trillion in national debt? Over $1 trillion a year just in interest payments. That naturally makes people worry about, printing money, devaluation, and then you add in all the internal political division, the polarization. It feeds this global sense of unease, doesn't it?
Absolutely. That downward trend in reserves, 71% down to 57.7%, isn't just numbers. It's a concrete sign of active de-dollarization efforts. Countries aren't just thinking about alternatives anymore. They're actively building them. If you step back, the U.S.'s own internal issues, combined with how it's used financial sanctions in the past, well, it's given many nations a strong incentive to break free from that dollar dependence.
So is what we're seeing then a kind of quiet, long game struggle playing out globally?
I think that's exactly right. It's this dramatic tension. The U.S. obviously wants to keep its dominant position, but more and more countries are actively looking for and building other ways. It's a definite long-term global shift unfolding.
Okay, so right at this moment of peak global financial tension, a completely new factor enters the game: blockchain. Now, everyone's heard of blockchain, but for today, the key thing to grasp is this. It created a totally new way to handle transactions, a way that crucially bypasses the traditional middlemen.
The intermediaries.
Yeah. Let's make it simple. Say, I want to send $100 to you. The old way. It always goes through a bank, right? The bank is the central authority, the trusted third party. But with blockchain, if we're both using it, we can skip the bank entirely. I send the money, it goes straight from my digital wallet to yours, no middleman. That feels pretty revolutionary.
It is, and the magic behind it, the core design, is something called synchronization.
Yeah.
When you initiate that transfer, it's not just a private message between you two. It gets broadcast instantly to all the computers, the nodes running that blockchain software across the world.
All of them at once.
All of them. And every single one records that transaction. This creates a shared, identical, unchangeable record everywhere. That's the heart of distributed ledger technology. It's secure, it's transparent, it's bookkeeping done by everyone together.
Wow. Okay.
And zooming out, that kind of decentralized system, that's the big vision behind Web 3.0.
Yeah.
This idea of an internet where interactions, transactions, everything bypasses central control points.
So if this new pathway lets people bypass central authorities, what does that mean for the U.S. and dollar hegemony? Is this an opportunity or a massive threat?
It's definitely both, a huge opportunity and a serious risk. For the U.S., it's either a chance to push dollar dominance into this new digital world or risk losing even more influence to these new alternatives. And if history's any guide, the U.S. is absolutely going to try and dominate this new pathway.
Okay, so the U.S. wants its currency used on these new blockchain pathways. But there was a problem with the first wave, right? Like Bitcoin. They were decentralized, sure, but they weren't really stable enough to be used like everyday money.
Not at all. They behave much more like digital collectibles, maybe. Highly speculative assets. Their value jumped around wildly. You couldn't realistically use Bitcoin to buy coffee if its price could drop 20% before you finished your cup.
Right. They were missing that stability, that anchor, like how the dollar, as we said, was anchored to oil. And that's where stablecoins come in. They were designed specifically to solve this volatility problem, to create a digital currency that's actually, well, stable enough to use.
Exactly. And the most common type, the ones really driving the market, are fiat collateralized stablecoins. The key idea is how they achieve stability. It's a direct one-to-one backing. For every single digital stablecoin created and put out there.
Like a digital token.
Precisely. For every token issued, the company behind it has to deposit one actual U.S. dollar into a real bank account. And that money is segregated, kept separate. It's not supposed to be lent out or anything. So if they issue 100 million stablecoins, there's $100 million sitting safely in a bank.
Guaranteed.
Guaranteed. That means if you hold one of these stablecoins, you can always, in theory, redeem it for one U.S. dollar, one-to-one. And this creates that powerful link we talked about. Stablecoins are anchored to the dollar, just like the dollar was once anchored to oil. That's the new digital anchor.
That's actually quite elegant. So what are the real concrete benefits for the U.S. in pushing this, apart from just staying relevant in the digital world? And where does something like that Genius Act fit into this picture? Is it creating stablecoins?
No, not creating them. They already exist and are massive. The act is more about legitimizing them, setting rules. It's about bringing them officially into the U.S. financial system, managing the risks, and encouraging their growth in a controlled way. As for the benefits for the U.S., two big ones. Long-term. It's absolutely about extending dollar hegemony into the digital age, getting that first-mover advantage on these new blockchain rails.
Keeping the dollar central.
Exactly. Short-term. There's actually a benefit for U.S. debt. A lot of that dollar collateral held by stablecoin issuers gets invested in U.S. Treasury bonds.
So more demand for U.S. debt.
Right. Which helps at least somewhat manage America's huge debt burden. So it's strategic on multiple levels.
Okay, but if you're, say, China or Europe or any other major economy, you're watching this and thinking, wait a minute, we don't want a U.S.-dominated digital future either.
Of course not. They see the same potential and the same risks.
So naturally, other countries are pushing hard to develop their own stablecoins, right? Like you mentioned Hong Kong.
Yes, absolutely. China is definitely using Hong Kong as a sort of testing ground, a bridgehead. Hong Kong's stablecoin ordinance that kicked in August 1st. That's all about creating a legal framework for their stablecoin ecosystem to develop in an orderly way.
This really feels like a critical turning point then. Stablecoins are sitting right at the intersection of different countries' challenges and ambitions. For the US, it's debt management and extending power. For China, maybe supplementing existing payment systems and building digital influence. It's not just finance tech, it's becoming a whole new arena for global competition.
It really is. And it's fascinating to see how different places are trying to balance innovation with risk. The U.S. is leaning on private companies, harnessing their energy. China is using Hong Kong's established financial system as a tool. But both seem very focused on keeping the risks contained, especially in these early stages. That includes actively trying to tamp down on wild speculation.
How do they do that? How do you suppress speculation in practice? What did Hong Kong do, for example?
Well, it's interesting. After Hong Kong's stablecoin ordinance became official, the stock prices of some related companies actually dropped.
Really? Why?
Because the Hong Kong Monetary Authority made it clear they weren't rushing things. They pushed back the timeline for actual stablecoin licenses to maybe 2026. And the application process is tough, very detailed. They initially signaled they'd only issue a tiny number of licenses, maybe single digits.
Wow, okay, so slow and steady.
Exactly. The message is, we want real, solid innovation here, not just a quick speculative frenzy. It kind of echoes past tech booms, you know. Think of the early railway stocks and the dot-com bubble. There's often this initial wild phase.
Followed by a crash.
Often, yeah. And then eventually the real lasting value emerges. So the smart players are focusing on that long-term impact, not the short-term hype.
Okay, so we've covered the history, the geopolitics, the tech. But let's bring it down to earth. Beyond all the high-level strategy, what's the actual promise here? What do stablecoins really do for people, for businesses?
I think it boils down to three key things we need to remember. They make things faster, more flexible, and more thorough.
That's a great way to put it. Faster, more flexible, more thorough.
And these aren't just catchy words, right? They're about real business goals.
Yeah.
The stablecoin itself is just the tool, the means to achieve these fundamental improvements.
Exactly. The means, not the end.
Let's take faster. The most obvious win is in transaction speed, especially crossing borders. If you run a small or medium-sized business, maybe doing international trade, this is potentially a huge deal.
A game changer for SMEs, potentially.
Totally. Imagine you're selling, I don't know, crafts online, and you get an order from Brazil. The old way. The buyer swaps reals for dollars, pays you, you wait for the payment to clear, maybe deal with exchange rate headaches. It takes days, involves banks on both ends.
Lots of friction. Lots. But with stablecoins, poof. Those intermediaries can disappear. The payment can settle almost instantly. And here's the really cool part. Because it's digital, you can attach instructions, a smart contract. So maybe the contract says, the moment the shipping tracker confirms delivery of those crafts, release the stablecoin payment automatically.
Instant settlement upon verified delivery.
Exactly. No more waiting for invoices to be paid, no more chasing payments. It turns those IOUs, those promises to pay, into something much closer to immediate cash. The efficiency boost could be massive.
Absolutely. Now let's talk more flexible and more thorough. This is where the potential gets even broader, I think, and affects almost everyone. The basic idea behind a stablecoin, remember, is a digital credential that reliably represents a real-world thing, in this case, a dollar.
Okay, a digital token for a real dollar.
Right. But that core logic, a digital token representing a real-world item, can be applied to almost anything of value.
Anything. So beyond just money, what else are we talking about?
Pretty much anything with definable value. This is where we get into ticketizing things, or what's formally called real-world asset tokenization, RWA. Think about it simply. A restaurant knows it has ingredients for 100 steak dinners tonight. It could issue 100 digital steak dinner tickets on a blockchain.
Huh, like a digital voucher.
Exactly. Anyone who buys that digital ticket is guaranteed their steak dinner. And crucially, they could instantly trade that ticket with someone else if their plans change. Or think bigger. Much bigger. Imagine a $10 million commercial building. Selling that outright is hard, right? Takes time, big investors.
Yeah, very illiquid.
Very. But what if you tokenize it? You could divide the ownership into, say, 1,000 digital shares, each worth $10,000, or even 10,000 shares at $1,000 each.
So you're fractionalizing ownership.
Precisely. Suddenly, That $10 million building becomes accessible to investors all over the world who might only have $1,000 or $10,000 in stablecoins to invest. This massively increases the potential pool of buyers. Liquidity goes way up. It lowers the barrier to entry for investing in things like real estate. It unlocks the value of that asset much more thoroughly.
Wow, okay. That really does open things up.
And it goes further. Individuals could tokenize copyrights to their music or designs. You could even structure it so you tokenize, say, just the rental income stream from a property, separating it from the actual ownership like a mini flexible IPO for just one aspect of the asset, all tracked on the blockchain. Flexibility and thoroughness combined.
So we've covered a lot of ground, from the deep history of dollar hegemony through blockchain shaking things up and now landing on stablecoins, making things faster, more flexible, more thorough. It's a really fascinating journey. And look, we've simplified a lot of complex stuff today, obviously. The real world is even messier, but hopefully you now have that core logic, that framework to make sense of the headlines and what's developing.
Yeah, the underlying principles are key.
And this isn't some small niche anymore, is it? The global stablecoin market is already worth over, what, $250 billion? And growing incredibly fast. This is a fundamental change in how value works, how it moves, how it's represented digitally.
It really is. And maybe a final thought to leave you with. Think about what these capabilities truly mean. Making almost anything instantly tradable, easily divisible, and accessible to anyone globally. How might that reshape not just finance, but our basic ideas about ownership, about how we interact with all kinds of assets, what everyday things, or even just parts of everyday things, might soon have their own digital tickets? Keep watching this space, because now you have the tools to understand the transformation that's happening right in front of us. And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.